The global economy starts 2023 on a slightly worried note. The US jobs growth has raised fears of continued hawkishness on the part of the US Fed, while China is expected to provide a counter as a potential engine of growth as it abandons its zero-COVID policy. What does all this mean for India? For an assessment of the trajectory of the Chinese, Asian and the Indian economy, I'm joined by Chetan Ahya, Chief Asia Economist at Morgan Stanley. Chetan, good morning and thank you very much indeed for joining us. Well, first up, let me dismiss what has been on us for the past 24 hours. Very strong labor data coming in from the US. Does it change your perception of what we should expect from the Fed? More hawkishness, and will that have any impact on Asian and Indian economy?
No, Lata, I think it's definitely an emphasis from the Fed that they want to keep policy rates high and they don't want to see undue easing of financial conditions because markets would then begin to price more rate cuts coming in faster. But at this point of time, we don't see any big need to change our forecast. So we are at that belief that the Fed will keep policy rates after taking it higher towards closer to 5%. They'll keep it at that level until December of 2023. And markets were pricing in rate cuts happening a little before that time period. And it's pushed back with that, the outcome that we heard from the minutes. Markets have then repriced a little bit upwards. But yeah, I think there's no big shift in terms of the thinking on implications of that monetary policy view in the US on Asia.
Okay. With that, let me come to your assessment of China. Do you think that it will be a smooth and a persistent, shift away from zero COVID? There are fears that they may, come back because of the increase in infections. Do you see a continuous opening up and stimulating policies?
I think, yeah, that's now a done deal. And to the extent to which they have now even taken the final restriction out, i.e. for Chinese population to travel outside of China and for the rest of the world to visit China. And that is opening up from today, or rather it opened on January 8th, yesterday. Sorry, it's going to open on this Sunday. I'm confused on the dates. On January 8th. So that's going to be the final restriction that will be removed. So no, we are not expecting any reversal on the easing of measures on COVID-related activities, but also COVID-related restrictions, but also in terms of the economic policies. They're continuing to announce more and more easing measures for the property sector. The regulatory environment for the tech sector is improving. So I think they are going for growth all out. And that's why we're expecting China's growth to accelerate meaningfully in 2023.
Okay. Well, what does that mean to inflation? Your report, the one that's fresh from the oven, is once again betting, like your December report, on a huge disinflation in Asia. But if China is going to become an engine of consumption, we already see metal prices higher. And a lot of commodity experts believe that that could also push up crude prices later in the year. China being one reason and because of other reasons. So you don't think that China could disturb the disinflation?
So, there are the two components of China's GDP that we should look at. So we're expecting growth to be driven more by consumption and not as much by investment. We think construction activity, both real estate plus infrastructure taken together, will not be that strong. And what we're expecting is bulk of the recovery will be driven by consumption. So, for example, consumption growth, which is expected to be about an average of 1%, will accelerate to 7% in 2023. And even that consumption growth is going to be more biased towards services sector rather than the goods sector. So this will have a modest upside implication for inflation for the rest of the world from the fact that, we do expect energy demand to get boosted as travel-related activities will pick up from second quarter. So there is some upside to energy prices, but the rest of the commodity space should see more modest impact. And that's not changing our view on the inflation outlook for the rest of the region. And also, when you're thinking about inflationary impact of China, you should remember the fact that, right now, what we've seen in the last few months is that there's a massive compression in goods demand that has happened in DMs. And so therefore, the goods demand supply balance has improved. And China's non-commodity PPI, which tends to matter more, has already entered into deflation.
Okay. Can you assess or give us a trajectory of India's inflation and interest rates? I'll tell you the couple of fears. One, that core inflation, and that was there in the Reserve Bank statement, is not picking off. And now there is a fear that services inflation also will be high. So India's inflation and its rate trajectory.
So look, I mean, we always looked at headline inflation in India because food has been an important component. So on the way up, we would focus on headline because, that's what consumers are facing. And so on the way down, I wouldn't just look at core. You have to look at headline. But it is fair to say that core inflation being somewhat sticky will mean that inflation will not go down significantly in India. But we still expect inflation to be, in the range of 5.5% from March of this year on a sustainable basis. And we think that that should be good enough for the central bank to pause at a 6.5% policy rate. There is a possibility that, if the Fed goes further, then the RBI might do another 25 basis points. But, at this point of time, we think that, about 100 basis points of real rates can be achieved with 6.5% policy rate, and inflation outlook should be more manageable for the Reserve Bank.
Okay. Your people who are listening to you are trying to assess the cost of capital for them for the rest of the year, industrialists in particular. Besides inflation and interest rates, the other factor that will impact will be the fisc. Today, we are going to get the advance estimates. What is your estimate of nominal GDP for this year and next? Do you think a fiscal deficit issue could crop up and push yields higher?
Look, I think in general, the fiscal deficit has been somewhat high, but we know the reason for that is that, economy hadn't fully recovered. So this financial year is still going to be high. But I think as you get to next financial year, you would have lower burden on subsidy on account of fuel, that is for kerosene. You will have lower subsidy burden for food. We've seen the announcement of the food that the government made earlier. That would reduce food subsidy burden in the next financial year. And at the same time, the fertilizer prices having come down so rapidly will mean that the fertilizer subsidy burden will also go down. So I think they should be able to reduce fiscal deficit by 0.5 percentage point next year and stay on that gradual consolidation path at this point of time.
So you are expecting something like 5.8 or 5.9 to be announced in the budget?
That's right.
Okay. But Chetan, just to persist on that point a little more, the coming year, we will not have a very good help from inflation. As you yourself point out, WPI inflation could be actually in low single digits, also because of the high base. All that will impact nominal inflation and nominal GDP and therefore tax collections. That is the worry that I hear from some of the economists, that the same tax growth, which was helped by higher inflation in the current year, may not be there next year.
So then, accordingly, they will have to contain expenditure growth in line with the tax revenue growth. But look, you are looking at two different sides of the same point, in the sense that low commodity prices means that the subsidy burden will be lower.
Okay.
And at the same time, nominal GDP growth would also be impacted. So, but I think to the net, to the extent to which I think the subsidy burden tends to have an overwhelming impact on the deficit outlook. I would say that this decline in commodity prices and therefore lower nominal GDP growth should still be manageable for the government.
Okay, so
to fiscal deficit.
Got it. So you don't expect fiscal deficit to push up the cost of capital for Indian business. The other recent worry has been a fall in consumption. We just had Bajaj Electricals, and he was speaking actually for the entire sector. There was a report by Kotak as well saying that consumer durables, consumer discretionaries, even in urban areas, the demand has been falling. Your assessment of growth, do you think that pent-up demand engine is over? Any dangers to growth? What are your forecasts for current year, for the next year, FY24?
So we are expecting moderation in growth. So we're expecting growth to be at 6.2%. It is only natural that growth slows now. There has been some pent-up demand that has been satiated, but I think the bigger reason is that the exports are softening, and so that will take away some upside to growth from in India. But look, you've got the PMI numbers for manufacturing and services, so they are pretty robust. So I don't see a reason for India's domestic demand story to get hampered. And I know that the data weakness could have been also distorted by the fact that you had a bump up before festivals, and there has been some slowdown after the festival. So I think only in the first quarter numbers, when the first quarter numbers come, we will know how much of this slowdown is temporary or long lasting. And our sense is that big picture, when you look at all the factors that is driving India's growth story, either the corporate balance sheet is fine, the banking system balance sheet is fine. At the same time, now you have benefits of some of the structural reforms that the government had taken up in form of pickup in capex. All that's coming through. So I think 6% number, 6.2% number that we have for next year seems pretty much on track.
Okay, well, I did a poll just ahead of these advanced estimates that will come out later today, and there are quite a few people who are calling for a sub-6 number, 5.8, and there is now this additional worry. There was always this worry that exports will not click, but now this slowly developing worry that the India domestic consumption is not what they thought it would be. But anyway, we will have to wait and see. A final question to you: is the worst over for the rupee? Do you think that there can still be an 84? Or do you think there's actually an appreciation this year?
So our base case forecast is that the dollar stays on a weakening path, and at the same time, therefore, we are bullish on the rupee against the dollar. The big picture story, we discussed at the start about the Fed. We think that the Fed is closer to the peak in terms of its policy rate hike path, at least as far as the market pricing is concerned. And we're expecting actually the Fed to cut by 200 basis points in 2024. And I know you would say that that's really farther away, but the way the securities markets and the markets operate is that they discount that. And that's what helps us to see lower 10-year bond yield and weaker dollar. So we think the dollar has peaked, and that will be the biggest factor that will support the rupee in 2023.
Okay. Well, Chetan, I wanted to start a whole conversation on whether India is an attractive destination as an alternative for China. But unfortunately, out of time, I'll take a rain check from you and do that discussion a little later. Thank you very much indeed for joining us and giving us a perspective on how the economy may pan out in 2023. Wrap up on Bazaar, Chartbusters will take the action forward.